The home price crunch is happening now, but how low will prices go and which areas will get hit the worst? Welcome to the Property Imperative Weekly to the 3rd of February 2018. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. Welcome to our digest of the latest finance and property news. There was lots of new data this week after the summer break. NAB released their Q4 2017 property survey, and it showed that property dynamics are shifting. They see property prices easing as foreign buyers lose interest and a big rotation from the East Coast. Tight credit will be a significant constraint, they say. National housing market sentiment, as measured by the NAB Residential Property Index, was unchanged in Q4, as big gains in South Australia and the Northern Territories, and also WA, still in negative territory, were offsetting easing sentiment in the key eastern states of New South Wales and Victoria. Confidence levels also turned down, led by New South Wales and Victoria, but South Australia and the Northern Territories were big improvers. First-time home buyers, especially those buying for own occupation, continued raising their profile in new and established housing markets, with their share of demand reaching new survey heights. But in contrast, the share of foreign buyers continued to fall in all states, except for new property in Queensland and established housing in Victoria, with property experts predicting further reductions over the next 12 months. House prices are forecast to rise by just 0.7% over the next year, compared with 3.4% previously, and will remain subdued in 2019. Apartments will underperform, reflecting large stock additions and softer outlook for foreign demand. Both CoreLogic and Domain released updated property price data this week. It's worth comparing the two sets of results, as there are some significant variations. And this highlights the fact that these numbers are more rubbery than many would care to admit. Overall, though, the trends are pretty clear. Sydney prices are sliding, along with Brisbane, and the rate of slide is increasing, though it does vary between houses and apartments, with the latter slipping further. For example, Brisbane unit prices have continued their downward slide, down to an average of $386,000, a fall of 2.2% for the quarter and 4.4% for the year. Here, units are actually at a 4-year low. Momentum in Melbourne is slowing, though the median value was up 3.2% to $904,000 in the December quarter, according to Domain. Perth and Darwin remains in negative territory. Domain said Darwin was the country's worst performer, with a 7.4% drop in its median house price to $566,000 and a 14% plunge in its unit price to an average of $395,000, thanks to a slowing resource sector. This same slowing also hit Perth, with a house price median fall of 2.5% to $557,000 and units 1.7% to $369,000. On the other hand, prices in Hobart and Canberra were up over the past year, and Hobart is the winner, but is it 17% or 12%? A big variation between the two data providers. And is Canberra 8% or 4%? It depends on which data you look at. Also, these are much smaller markets, so overall prices nationally are on their way down. My take out is that these numbers are dynamic and should not be taken too seriously, though the trend is probably the best indicator. Perhaps their respective analysts can explain the variations between the two data sets. I, for one, would love to understand the differences. The ABS, of course, will provide another view on price movements later, but not for several months. The latest ABS data on dwelling approvals to December 2017 shows that the number of dwellings approved fell 1.7% in December, in trend terms, and has fallen for 3 months. Approvals for private sector houses have remained relatively stable at just under 10,000 houses approved in December. But the fall was in the apartment sector, especially in New South Wales and Queensland. more evidence of the impact of the rising current supply of apartments and why high-rise apartment values are on the slide. Also, the ABC highlighted the fact that real estate sales companies are using big commissions to tempt mortgage brokers, financial planners and accountants to sell overpriced properties to unsuspecting clients. This is a way to offload the surplus of high-rise apartments and looks to be on the rise, which is another indicator of risks in the property sector. In other economic news, the ABS released the latest Consumer Price Index, the CPI, which rose 0.6% in the December quarter. Annual inflation in most East Coast cities rose above 2%, due in part to the strength in prices relating to housing. This follows a rise of 0.6% in the September quarter. However, there were some changes in methodology which may have impacted the results. Softer economic conditions in Darwin and Perth have resulted in annual inflation remaining subdued there at 1% and 0.8% respectively. Now, many commentators use this data to push out their forecast of when the RBA may lift the cash rate, but my view is we should watch the international interest rate scene, as this is where the action will be. Whilst the Fed held their target rate this week, there is more evidence of future rate rises ahead. Most analysts suggest 2 to 3 hikes this year, but the latest employment data from the US may suggest even more. The benchmark T10 bond yield continues to rise, and it is at its highest since 2014 and now close to that peak then of about 3%. Have no doubt, interest rates are on their way up. And this will put more pressure on funding costs around the world and put pressure on mortgage rates here. In fact, Alan Greenspan, the former Fed chair, speaking about the US economy, said there are 2 bubbles. We have a stock market bubble and we have a bond market bubble. Irrational exuberance is back. He said, we're working obviously towards a major increase in long-term interest rates, and that has a very important impact on the whole structure of the economy. Greenspan said, as a share of GDP, debt has been rising very significantly, and we're not just paying enough attention to that. US rate hikes will lift international capital market prices, putting more pressure on local bank margins. We published our latest mortgage stress research to January 2018. Across Australia, we found that more than 924,000 households are estimated now to be in mortgage stress, compared with 921,000 last month. This equates to 29.8% of borrowing households. In addition, more than 20,000 of these are in severe stress, down 4,000 from last month. We estimate that more than 51,500 households risk 30-day default in the next 12 months, which is down 500 from last month. We expect bank portfolio losses to be around 2.7 basis points, though losses in Western Australia are likely to be closer to 4.9 basis points. Some households have benefited from refinancing to cheaper owner-occupied loans, giving them a little more wriggle room in terms of cash flow. The typical transaction has saved up to, say, 45 basis points or $187 each month on a $500,000 repayment mortgage. You can watch our separate video blog on the results, where we count down the top most stressed postcodes in Australia. But the postcode with the highest count of stressed households, once again, is a New South Wales postcode 2170, which is the area around Liverpool, Warwick Farm and Chipping Norton, which is 27 kilometres west of Sydney. There were 7,375 households in mortgage stress here, up by more than 1,000 compared with last month. The average home price is $815,000 compared with $385,000 in 2010. There are around 27,000 families in the area with an average age of 34 years. The average income is $5,950 a month. 36% have a mortgage and the average repayment is about $2,000 each month, which equates to more than 33% of average incomes. We continue to see mortgage stress still strongly associated with fast-growing suburbs, where households have bought property relatively recently, often on the urban fringe. The ranges of incomes and property prices vary, but note, it is not necessarily those on the lowest incomes who are the most stretched. Banks have been more willing to lend to these perceived lower risk households, but the leverage effect of larger mortgages has a significant impact and the risks are underestimated. The latest data from the Australian Financial Security Authority for December 2017 quarter shows a significant rise in personal insolvency, which is a bellwether for financial stress within the Australian community. The total number of personal insolvencies in the December quarter was 7,578, and that's increased by 7.4% compared with December 2016. This year-on-year rise follows a rise of 8% in the September quarter 2017. This is in stark contrast to the latest business conditions survey from the NAB. They said that the business confidence index bounced 4 points to plus 11 index points, the highest level since July 2017, perhaps driven by a stronger economic backdrop, and it closes the gap between confidence and business conditions. They say business confidence is strongest in trend terms in Queensland and South Australia, and to a lesser extent in New South Wales. Confidence is also reasonable in Western Australia, and it is in line with business conditions in that state. But Victoria and Tasmania are reporting levels of confidence which are lower than their reported level of business conditions. But the employment index suggests employment growth may ease back from current extraordinarily high levels. The RBA credit aggregates data reported that lending for housing grew 6.3% for the 12 months to December 2017. That's the same as the previous year, and the monthly growth was 0.4%. Business lending was just 0.2% in December and 3.2% for the year, which is down from the 5.6% the previous year. And personal credit was flat in December, but down 1.1% over the past year, compared with a fall of 0.9% last year. This is in stark contrast to the payday loan sector, which is growing fast, actually more than 10%, as we discussed in our blog recently. And that data is not included in the RBA figures. Investor loans still make up around 36% of all loans, and a further 1.1 billion of loans were reclassified in the month between investment and owner-occupied loans. And in total, that means that more than 10% of the investor mortgage book has been reclassified since 2015. The latest data from APRA, the monthly banking stats for ADIs, shows a growth in total home loan balances to 1.6 trillion, up 0.5%. Within that, lending for owner occupation rose 0.59% from last month to 1.047 trillion, while investment loans rose 0.32% to 553 billion. 34.56% of the portfolio is for investment purposes. The portfolio movements within institutions showed that Westpac is taking the lion's share of investment loans. We suggest this involves significant refinancing of existing loans. CBA investment balances fell, while most other players were chasing owner-occupied loans. But it's worth noting that the AMP Bank looks to have reclassified a significant number of loans, which will distort the numbers. 1.1 billion overall were reclassified, as we discussed a few moments ago. So standing back, the momentum in lending is surprisingly strong and reinforces the need to continue to tighten lending standards. But this does not gel with recent home price falls, so something is going to give. Either we will see home prices start to lift, or mortgage momentum will sag. Either way, we are clearly in uncertain territory. Given the CoreLogic mortgage lending indicator stats were down, we suspect lending momentum will slide following lower home prices. We will publish our Household Finance Confidence Index this coming week, which will give us an updated read on household intentions. But in the major eastern states at least, don't bank on future home price growth. If you found this useful, do like the post, leave a comment, or subscribe for future updates. And by the way, our special post on Bitcoin will be out in the next few days. We've had to update it based on recent market gyrations. I'm Martin North, Principal at Digital Finance Analytics. Many thanks for taking the time to watch.